This meeting is being recorded.
Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. And we're going to talk about an Instagram page you must be following. I look at it every day because it has just some wild ass stories and big ass numbers that get me excited. And that, of course, is Life Goal Investments. And Taylor, how you doing, buddy?
I'm doing great. I'm excited for this. This will be fun.
Yeah. So again, you put out great stories. You talk about the time you raised $1 billion and all of these crazy things. But dude, I want to hear about a $1 million dinner.
Yeah.
I'm a sales
that's
guy.
That's not normal?
No, dude, I'm a sales guy. I've gone out to dinners. I've seen a $10,000 bill. I think I saw a $12,000 bill, but $1 million dinner bill. I've got to just sit back and hear the details of this story. What do you got?
Yep. So this was back in 2007, right on the precipice of the greatest, recession that we've seen outside of the Great Depression in the country. And my boss at the time was going to dinner, and he owned a boatload of Citigroup stock. Okay. And so, as we all know, you talk about diversifying your own corporate risk and not holding on to all of the stock that also predicates your income level. But at the time, and to his credit, going into this meeting, he literally was telling his boss, like, I'm diversifying, I'm getting out of the way of this. Not that I think things are crashing or anything like that. I just can't take, several $1 million worth of exposure in one single stock, which is what I have right now. And not to mention, the health of that stock also is the health, again, of my income level. So anyway, his boss gives him the worst advice of all time. And he said, and he's right to an extent, so we can discuss this, but he said, concentration creates real wealth. Diversification does not. And so, to his credit, I'll say this. He's very right if he's right? His boss is very right if he's right. If you're right, you want to be as concentrated in that individual stock as you ever could be. But when you're wrong, that is where you're where you're overexposed. So this guy had several $1 million in Citigroup stock. It went from over $500 a share. I think it sits at $50 a share even today, more than a decade later. He lost over $1 million in a 1 month period of time.
Oh,
and he said that is what costing yourself $1 million at dinner looks like. He said it was the worst dinner he ever had. He said it was the greatest feeling ever when he left, because he's like, you know what? I am going to be absolutely rich off of this, because that was what his boss was alluding to at the time. His boss got whacked very soon thereafter. Obviously not anything predicated on this, but just the fact that he was that middle level, upper middle level management, and that whole tier, bang, gone, out. Yikes.
Yeah. That is
this
crazy.
Is not, and this is like, so I actually just read an article from The Guardian, which is, I think it's a UK based newspaper.
It is.
And it was talking about the crypto situation that people face right now, and the fact that there is legitimate, what's the word I'm looking for? When you're addicted, you go to rehab for crypto traders. And I literally stopped reading the article halfway through because it was so depressing. Like, they got really detailed as to what the things these people were facing, kind of how it played out. And they talked about the fact that it's like this reoccurring piece where they dipped their toe in crypto and they had a really good experience, whether it was 2020 or 2021. They were all kind of in that time frame. And what they did was they got down these rabbit holes on Discord groups and on forums and on chats where it's all one-sided. Everyone in there is a crypto bull, and they just prop each other up time over time over time. And the article doesn't mention this, but like, what people have to realize with crypto, and again, I'm not beating up crypto, that's not the intention here. Crypto has a standard deviation, which is the way you measure volatility in the markets, of 80. For context, the S&P 500 has a standard deviation over the same period of time. That measurement is of 15.
Yeah.
So you're talking literally a 5-time multiple, somewhere in that ballpark.
Yeah.
And it's just like, holy smokes. And then people were leveraging themselves on top of it. So again, I'm down a rabbit hole of just babbling at this point. But what we're getting at here is concentration is a real risk that if you're right, you can be very right. Mm-hmm. But investing is not in this concentration camp. That's gambling.
Well, this is really interesting, because if you followed Warren Buffett and Charlie Munger long enough, you see these two gentlemen who are giants in the industry kind of battle this. So here's my take on it. I'd love yours. I think Warren Buffett and Charlie Munger agree. Like, if you gave them true serve, they would both say the same thing. However, Warren Buffett is much more out in front of the camera. He knows his words mean something, and he wants to protect the average person. So you very much hear Warren Buffett say index funds and this, that, the other thing. And then if you can corner Charlie Munger, he's going to tell you concentration wins, diversification sucks. Put all your eggs in one basket, watch the freaking basket. Again, I believe they both agree. But Warren Buffett is smart
with the latter point.
With the latter part, yes.
Yeah.
But Warren Buffett is smart enough to realize that the average investor that listens to him won't do the work. And if you don't do the work, don't concentrate your bet.
So I've talked about the stat with you before. And so we'll look at 3 different buckets. We'll look at stocks, bonds, and the average investor. And just to pile on to your point, the difference is they're doing work. Warren Buffett spends 6 hours a day reading. Warren Buffett has a team of analysts. Warren Buffett works with Charlie Munger, who he bounces ideas back and forth off of, who's a brilliant mind, although he's 97. I don't know how they're so sharp. Anyway, at the end of the day, here's the stats. The stats are the S&P 500 over the last 20 years have averaged 7.5% return per year. The bond market, the Barclays Ag, which is the S&P 500 of bonds, has averaged 4.8% per year over the last 20. The average investor has averaged 2.9%. 7.5, 4.8, 2.9. How do you get so low? The essential answer to that, mathematically, unequivocally, you can't argue this is not the case, is people taking too much risk. Why? Because that leads to them buying highs and selling lows and not being able to stomach the difference between the two. If they were able to sit in any asset class, you look at real estate, you look at infrastructure, you look at any of them, all of them have a higher return average over that 20-year period of time than the average investor at 2.9%. But the average investor doesn't sit in the seat through the tough times.
Yeah. For me as an investor who kind of like that crypto article in Guardian, right? I took $7,000 stack, turned it into 200,000. I remember thinking I was better than Warren Buffett, and then I got smashed when I realized the market was going against me. Just like David Portnoy, who was very public about saying he's better than Warren Buffett, old man.
Yep.
How'd that end up? So again, my kind of experience is the same. You get a taste, you do the work, it works out. The market, you don't appreciate that the Fed is helping you or whatever it is. Then you get a little more aggressive. Then you stop doing the little bit of work you were doing, and it still pays off. And then you start gambling, and then the house wins.
Yep. So here's a cool one. And this is going to sound like the most boring portfolio of all time. So I'll lead into it with the performance to try to get you off that boring topic, because I'm going to tell you what it is and you're going to go, what? So if you look at 3-year periods of time, so if you take a snapshot every single month and look back 3 years,
okay,
you can do that with this investment that I'm going to reference 522 times. That's how long backwards you can do it. 522 periods of time.
Okay.
Out of those 522 periods of time, this portfolio returns positive returns, 522 of them. So anytime you had owned this for a 3-year period of time, you produce positive returns. And what are the positive returns? It averaged an annualized 8.54% per year, 8.5% per year. So here's what it is. 60% bonds. Boring, right? Okay. 30% S&P 500, 10% gold. So again, 60% bonds, 30% S&P 500, 10% gold. You can track that back, that blend of assets back to 1976, because before that, they don't have an index for it. So with that blend, 522 3-year periods that you can look at, it was positive 522 of them time. Because that's what I'm saying there is, if you held it for any 3-year period of time, you would have been positive. The average return over that time, 8.54% per year.
And now what you're saying, just in the numbers, some of those times it's very low, but it is still positive, and sometimes it's above that. That's what you're highlighting.
Yep. And but the average at the end of the day is the average, 8.5.
What, again, I'll just ask, if you don't know, it's okay. If you were going to name 3 indexes that if somebody wanted to repeat that today, would it just be the Barclays Ag, the QQQs, and I don't know, gold? I don't know what gold's ETF is. GLD?
Yeah, so not QQQ. QQQ is going to put you in NASDAQ oriented.
Oh, I'm sorry.
In the tech oriented stuff. Yeah, so like VOO would be Vanguard's version. So here, this is kind of a backdoor into a shameless plug, by the way.
Sure.
So that's really what our ETFs do. Is one of them specifically does that blend of assets.
Oh, there you go. Which one is that?
You can do it with one single ticker, not 3.
There you go. Who
no,
knew?
So our ETF that has that kind of approximate blend of assets is SAVN, SAVN.
So again, it's 60% bonds, 30% S&P, 10% gold, roughly speaking.
Yep. Just about. Yeah. And it's actively managed. So when we see opportunities to dial up or down risk, it will do that. But that being said, that's the approximate blend of assets that sit inside that portfolio. But what
I had no idea that's where we were leading to. That was pretty good. That was good.
But what? So yeah, again, I kind of backdoored my way into that one. But
Yeah,
what I would say is like, how boring does that sound? Like to the average person, 60% bonds. They're like, bonds are for old people. 10% gold, 30% stock, like that. But look at the returns and what it allows you to do. It also takes that 16% standard deviation that we talked about for stocks and drops it to less than 7.
I just got to ask, do you have a PDF or an article or talk about because I'm guessing you did this review 522 times. Is there anywhere we could find that and go, hey, let's read about that?
So you'll get an Instagram post, so you can look at it there. And it'll be entertaining because it talks about batting 1,000 and this guy hitting a homer and throwing his bat. It's hysterical. But also on our website. So on our website, there's a historical performance tab, and it specifically references that blend of assets.
All right. You know what? I'm going to ask you to do me a favor. Send me the link in a text or whatnot, and I'll put it in the show notes because I know there's people are going to geek out and want to read that. So if you can send it to me, or email's fine, I guess. I'd appreciate it. Where can people find you?
Awesome. Yeah. Find us at Life Goal Investments on Instagram.
Very cool. Thanks, buddy.